PantheonAI presents Stock Market Shock. Trump tariff deadline and Apple's struggles could change everything. Welcome to the PAI Morning Briefing. I'm John, and today is July 31st, 2025. Grab your coffee, everyone, because we have a lot to unpack.
Good morning, John, and good morning to all our listeners. I've got my coffee right here. It feels like one of those days where we're going to need it. The mood out there feels cautious.
Cautious is the perfect word, Sarah. Let's start with the market overview. The S&P 500 closed at 6,386.82, which is a decline of about 0.62%.
Right, not a huge drop, but definitely a sign that investors are feeling a little wary. What about the Dow?
Same story there. The Dow was also trending lower, finishing at 44,406.72, down almost 0.6%. The Nasdaq wasn't far behind either, concluding near 21,292 with a drop of about 0.77%.
And the Russell 2000? Our usual gauge for the smaller guys?
It echoed that sentiment, finishing around 2,219.8, though with a slightly smaller drop of 0.3%. So a sea of red, but not a tidal wave.
Interesting. Now, over in the crypto sphere, things are a bit more mixed, aren't they? Bitcoin actually managed to defy the trend.
It did. It edged up about 0.3%, hitting nearly 118,176. But Ethereum told a different story, dropping about 0.34% to land near 3,795.
So even in the world of digital assets, not every coin is dancing to the same tune. It really sets the stage for what we're seeing everywhere else. Investors are navigating some choppy waters right now.
Exactly. And that brings us to our deep dive. A lot of this caution is being driven by some major trends, from domestic policy to global pressures. Sarah, that shadow of trade policy uncertainty seems to be getting longer.
It really is. With the Trump tariff deadline just one day away, you can feel the tension. Reports are flooding in that wholesalers and distributors are preparing for a potential storm. We're talking about sectors that make up a third of the nation's GDP.
A third of the GDP. That's massive. And they're bracing for an additional $50 billion in tariffs? I imagine they're not just going to absorb that cost.
Not at all. They're planning for price increases to protect their profit margins. This is what contributes not only to supply chain headaches, but also that broader inflationary pressure we've been seeing.
Speaking of inflation, that's the other big headline, isn't it? The Personal Consumption Expenditures Index just posted its biggest rise in 4 months. And part of that is the delayed effect of these tariffs filtering down to us, the consumers.
Right, so that leaves the Federal Reserve in a really tricky spot. Do they cut interest rates to stimulate the economy? Or do they hold firm because inflation is ticking up? What's your take?
Well, it's like trying to decide between a latte with or without an extra shot of espresso. Both options have consequences, and the wrong move could leave a bitter aftertaste for the whole economy. It's a real balancing act.
That's a great way to put it. And adding to that complexity is consumer spending. We're seeing reports that people actually spent more in June, which sounds good on the surface.
But there's a catch, I assume.
There is. There's a layer of caution behind that spending. It's as if people are testing the waters, ready to jump back if the tide suddenly turns. You know, like dipping your toe in a pool you think might be too cold.
That makes perfect sense. And you can't talk about market sentiment without talking about tech, specifically Apple. There's a lot of chatter asking, what will it take for Apple to get back in Wall Street's favor?
And it's not just an Apple problem, is it? It reflects a broader cooling off towards the entire tech sector. You've got regulatory pressure, changing consumer habits, intense competition. The market is clearly expecting Apple to pull another rabbit out of its hat, and soon.
It really feels like watching a high-stakes chess match where every move is critical, except sometimes it feels like someone might just knock the whole board over by accident.
A stray elbow could change the whole game. You know, it's worth circling back on some of these key stories because they are so interconnected. The tariff deadline, for example, multiple reports are stressing that if negotiations fail, we're going to see significant price hikes ripple through the economy.
And that inflation story is just fueling the debate over the Fed's next move. Traditionally, you fight inflation by tightening policy, but with parts of the economy still sluggish, they might be forced to cut rates. It's like trying to set the thermostat in a house where one room is freezing and another is boiling. There's no easy answer.
And this cautious consumer behavior we mentioned, that's a recurring theme. It suggests that even if people are ready to spend, those underlying fears about the economy are holding them back. And when consumers are cautious, businesses get cautious too.
Which brings us back to Apple. The repeated coverage tells us the pressure is mounting. It really makes you ask, has Apple's once untouchable aura finally cracked? Or is this just a temporary storm cloud?
Only time will tell. And of course, these aren't just U.S. issues. Global markets are watching every move. European and Asian markets are adjusting their own forecast based on our trade policies and inflation trends.
It's a powerful reminder of how hyper-connected we are. A tariff decision in Washington can cause ripples in Tokyo and Berlin. It's a global domino effect.
Absolutely, and let's not forget the energy sector. It's in a constant tug-of-war between fluctuating crude prices and the big push toward renewables. It's a debate happening in boardrooms and in the halls of government.
And the financial sector is feeling it too. Banks are preparing for a cautious year, with credit markets likely to stay tight. It's that same cautious stance we see from consumers, just on a much larger scale. The whole system seems to be on a tightrope.
So let's dig into that sector analysis a bit more. With tech, it's clear the old rules don't apply. Investors are asking tough questions now. Can innovation keep up with regulation? It feels like a Rubik's Cube. Every time you solve one side, you mess up another.
And in energy, that future is all about who can adapt. Traditional companies are being forced to confront a world with less reliance on fossil fuels. The big question for investors is, which companies will lead that transition to renewables? It's a multi-trillion-dollar question.
Definitely. And for finance, it's all about being nimble. With consumer debt, interest rates, and global uncertainty, banks have to reassess everything. It's like trying to navigate through waters where the depth keeps changing without warning.
Looking at the expert predictions, the consensus seems to be that we should brace ourselves. Many analysts are warning we're entering a period of prolonged economic adjustment. Some even worry that if central banks cut rates too aggressively, we could inflate another asset bubble.
Though others are more conservative, suggesting this is just the natural ebb and flow of the market. I think in times like these, a little humor helps. I see the market's mood like a cautious driver on a rainy day. Everyone's going a bit slower, taking turns carefully, and maybe honking a little more than usual.
That's a perfect analogy. It reminds us that while we can't control the weather, we can control how we drive. So as we wrap up, let's crystallize the key takeaways for our listeners.
Okay, takeaway number 1. Caution is the word of the day across all major indexes. Even crypto is split, showing how different assets react to the same pressures.
Takeaway number 2, trade uncertainty is the big recurring theme. That looming tariff deadline is casting a long shadow, fueling both price hike fears and the inflation we're already seeing.
And number 3, we're seeing major strategic shifts. Tech giants like Apple have to prove themselves again. Energy companies are at a crossroads between old and new, and financial firms are battening down the hatches.
And finally, the global perspective is crucial. What happens here doesn't stay here. These ripples are felt worldwide, which means investors need to think globally.
So, looking forward, it seems prudence is key. Diversification, rebalancing portfolios, and looking for sectors that are resilient to these specific pressures, like renewables or companies less sensitive to tariffs.
Right. In these moments of flux, being informed is your best tool for making sound decisions. Which leads us to some questions for you, our listeners, to think about.
Exactly. How will this tariff decision really reshape things on the ground? Can the Fed's response to inflation actually stabilize the economy? And for tech investors, what does Apple's next move mean for the entire industry? These aren't just rhetorical questions. They're worth a deep dive.
And a great place for that deep dive is with our sponsor, PantheonAI, your information copilot in these turbulent times. You can punch in these very questions and get comprehensive insights and actionable intelligence.
So to wrap up our conversation today, caution is the name of the game. The tariff decision is a huge specter, and everyone from consumers to corporations is treading carefully. It's a complex but fascinating economic story unfolding before our eyes.
And as we close, we invite you to consider, how might you adjust your own strategy? What sectors offer resilience? And how can you leverage next-level insights like those from PantheonAI to stay ahead of the curve?
Thank you all for joining us on the PAI Morning Briefing. Your engagement is what makes these discussions so valuable.
We look forward to exploring tomorrow's market with you. Until then, stay informed and stay curious. Learning shouldn't feel like a full-time job.
Pantheon AI, your information copilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.